Let's get across the market open now. Zach Rio is joining us from Banyan Tree Investment Management. Zach, welcome to you on this Tuesday. Just taking a look at what happened overnight. Those bond yields in the States, they're sort of sitting about 4% now on expectations that those rate cuts are not going to be as aggressive as initially thought.
Yeah, good morning. 200 odd basis point of rate cuts were priced in. I think they're quickly getting priced out now. We've been low to no duration in our portfolios. We continue to maintain that. What's interesting is there's enough fiscal and liquidity finding itself into the market. We were looking at one measure, Andrew, which encompasses a bunch of liquidity measures, front door, back door, side door, whatever you want to call it. Since August, here's a little figure for you, $4.1 trillion in liquidity has been added to the market since August. So, Andrew, you give me money, I will find places to put that money in. And that's effectively, this is what's happening in the market. So the markets are reacting to, I guess, fiscal policies, liquidity, and generally very strong employment. And this is where we think inflation 2.0, the prospects of inflation 2.0, maybe not the mother of 1970 styles, but maybe its cousin or little child, is still a proposition that we're not willing to put behind us. So we're still underweight duration to no duration in our portfolios, and we think yields are going to continue to back up. And so, look, yields duration could be a trading activity for most investors or some investors right now, but for us who don't tend to turn our portfolios over too often, we're just going through other alternative methods to find defensive rather than duration, which still has the potential of being sold off in the case of a increasing inflation scenario.
So when you're looking at those opportunities of where to invest in, how attractive is China right now, given how it has surged? So just taking a look, Goldman Sachs saying those Chinese stocks may surge another 20%.
Yeah.
Is that possible in your book?
Yeah, so I think it is possible. I think one of the points is China, MSCI China is trading at a PE multiple of 11 times, and that's where it is. I mean, it's funny, only a couple of weeks ago, it was trading at 8.5 times. We've got a position in China already. We're actually not adding to China right now, but we're quite comfortable with the position. You can see the PE multiple for MSCI China has just gone back up to its 10-year average. Now remember, that 10-year average also includes the last 3-4 years of absolute PE multiples in the doldrums. So it's not like, there was a spike in 2020, but there was also PE multiples, pretty depressed PE multiples that a long-term average is encompassing. Now, what we would say is from here, while we continue to maintain it, I think easy gains are probably likely over. But if China's stimulus package starts to come through like the policymakers have suggested, $1.2 trillion in USD terms, that's going to have some impact if it eventuates on earnings. And I guess the next potential earnings upgrade cycle could drive the market higher. I think maybe that's what Goldman Sachs is looking at, but that's certainly what we're looking at for a potentially higher market from here. But one thing I think the stimulus package does do, Andrew, is at least puts the left tail risk of the downside to Chinese equities from here, provides us some buffer there.
In fact, today we're going to hear more from China.
Correct.
The top economic plan is going to outline further detail there. So
everyone's looking at that as well. So.
Yeah, particularly given we've just had that week off in China too. So watch China market in particular today. Now, of course, given what we've seen out of China, that's been a great benefit to the material sector, particularly here. How are you looking at commodities?
Look, so I'm not crying, Andrew. I think I've just got something in my eyes. But look, material sector for us is something we've been, certainly across our multi-asset strategies, we've been loading up on since June, in part driven by the Middle Eastern concerns. You think about it, right? So we've added BCom to our portfolios, our multi-asset strategies, and the blue line is the BCom and the orange line is the 10-year bond yields, and there's a strong correlation there. So we think that BCom line, commodities complex, goes higher. I think people are still underappreciating the potential disruption to commodities from the Middle East conflict. Look, the Strait of Hormuz, that pretty much trades about 20% of global oil. Okay, sure, Iranian oil, about 8% of global supply goes predominantly to China. But if you knock that out, and if you're Israel, I'm assuming you're not going to try to knock out their ATM machines. You're going to try to knock out their economic powerhouse drivers, which is oil. So if oil goes, and Iranian oil goes, and that Strait of Hormuz, with the help of Yemenis, becomes a difficult proposition to pass through product, then what you're going to see is a spike in commodities, and you've started to see that. Oil has finally started to react. Just to give you a bit of a sensitivity analysis, Woodside for one, every 1% movement in oil does have about 3% movement in its earnings and share price. So, there's a fair bit of sensitivity in the local oil stocks. So we have Santos, we have Woodside, we have Ampol, we have Worley Parsons, which is obviously just a service provider. The one thing I would add about, Ampol is cracks. Refinery margins have absolutely been smashed recently, and that's because refinery margins in Singapore have declined by 50% But if these geopolitical events continue to escalate, I wouldn't be surprised if those things, if the refinery margins start to get a bit of support as well. And so, Ampol's already been, it's still down on a 5-year, it's still up, but it's come off a fair bit. And don't forget, Ampol's got that convenience business as well. But right now, what's driving the price is obviously the oil market. So these stocks are in our portfolio, not only for individual stock-specific reasons, but exactly what's happening in the Middle East right now. And so, like I said, you take out 20% of global oil supply, you're going to see a reflection of that in the price, and we're prepared for that across.
Now, Zach, of course, elsewhere in the materials sector, big news yesterday with Rio's tilt at Arcadium Lithium. Does that make sense to you?
Absolutely. As a shareholder in Lithium, Arcadium, we've been bruised a little bit there. So look, over long term, over the last 5-6 years, we've had a position in lithium. We've done well out of it since the whole Arcadium, and obviously lithium prices have come down. But you just think about it, you're buying a high quality business at the bottom of the cycle, and with a half decent growth proposition. So, and a fairly clean, shareholder list as well. There's not too many kind of founders and whatnot that could stand in your way. It makes a lot of sense to us as a lithium, as an investor in Arcadium. We would like a much higher share valuation.
Of course you would.
Of course, and but hopefully more around the $8 to $10 billion mark, which is the pre-merger market cap, and that before the fall. Something around that mark would be a bit more happy. But I think this story isn't ending just yet, and has lifted the whole cycle. The whole commodities lithium complex. So